So risk management. Ultimately, a lot of people brag about how much money they make, and we're in this business to for a number of reasons. So we certainly don't mind promoting and showing off our results either. But most people don't talk about the other side of it, right? The other side of it, to make money, you have to take risk. And if you have a tremendous year in returns, I hear that all the time from people that send us their examples of their strategies and so on. And that's great until you dig in and realize how much risk they were taking. So we do the best job we possibly can to minimize risk while maximizing returns. And we do it a number of ways. There's a daily risk budget for each program. So program is a collection of strategies. They're all trading the S&P 500 index futures with different types of strategies within them. So most of them are very diversified, but that whole program for the day has a max daily risk, the maximum that it will possibly lose in a single day. And that's first and foremost the way that we keep things from getting out of control if we catch a bad run or markets not conforming with historical biases or norms. So we have a daily risk budget. It varies anywhere from $1,500, I think our smallest program, the Meta program, up to I think it is $9,200 for our largest program. That's risk in a day. So you have to be able to handle at least a $1,500 risk. If you can't handle that, then we're probably not going to be a good fit for you. And that's in a single day. And the programs can lose more than that because we can have multiple successive losing days or a preponderance of losing days over a period of time. And you can lose more than that. We'll talk about that next week. But that's why I will say this, and maybe I should have said it before. If you're new by chance, you need at least $30,000 to start with. If not, no problem. Let us know. We do have friends in the industry, and that might be able to help you out. So the other way we manage risk is through diversification. As I mentioned, the portfolios are literally portfolios of multiple strategies with different stops and targets, different edges, and so on. And that helps reduce the risk, so we're not dependent upon one single strategy, with sort of one exception noted. I guess Meta is a complete machine learning based strategy. It either goes long or short or does nothing. So it's going to be a little streakier long term, though it hasn't really been that way in live trading over the past year. Over the long term, will be a little bit more volatile, I believe. We use market orders. That's really important. We're not using limit orders to get out of the market. When we want to get out, when it's triggered and hit our max threshold, we want out, and we want out now. Always, 100% of the time when you're trading futures, that's the only way to go, in our opinion. You're just playing with fire if you use limit orders. It's a long shot. It's probably a 1 in 1,000, 1 in 10,000 these days, maybe even less odds than that. But if the market makes an aggressive move, and you don't want to be in a situation where your exit got skipped because you had a limit order requiring it to only fill you at a specific price. We don't do that. If it hits our level, we want out. We'll take the slippage. And we'll be out and be happy that we were out. We do have redundant monitoring. I have multiple members on our team are watching every single order. Remember, we're trading these things ourselves, but also the signals themselves, as well as the execution broker. They've got a team. We have no overnight risk. So by doing so, we're greatly minimizing our exposure to the market. And we're doing so, importantly, in that longer and less liquid period where you can get yourself in trouble sometimes and have lots of slippage and so on. So we never, ever take on overnight risk. That's why I argue all the time that we're safer than the stock market. Now, the brokers, if they were listening, they would say, you can't say that about futures and so on. But honestly, that's why we do what we do, because that's how I think about it. And we actually have risk off. Some of it's automated. Some of it is a manual override, which we can do if we ever need to. I think last time we did was years ago, but we can turn things off if there's some one-off risk event happening. Very, very rare. We do have some of the automated cutoffs that happen with ultra extreme volatility, but that's pretty rare as well.